Welcome to this deep dive on the UTMA Roth IRA Trap. In this video, we will explain why using capital gains from a UTMA account does not qualify a minor for a Roth IRA contribution. We will also clarify the difference between earned and unearned income, highlight the Kiddie Tax pitfalls, and show you the correct, legal ways to fund a minor's Roth IRA. To guide you smoothly, we will move step by step and use diagrams to visualize the concepts. First, we will outline how UTMA accounts work. Next, we will define earned versus unearned income and how that applies to Roth IRA eligibilities. Then, we will explain why capital gains and dividends from UTMA accounts cannot be used to justify Roth IRA contributions. After that, we will spotlight the Kiddie Tax and its implications. Moving on, we will cover legal strategies to generate earned income for minors, followed by a practical documentation checklist. Finally, we will test your understanding with a couple of quick quizzes. Before we start, a quick but important disclaimer. This presentation is for educational purposes only and does not constitute tax, legal, or financial advice. Rules can change, thresholds are indexed over time, and state laws may vary. You should consult a qualified tax professional or financial advisor who can consider your family's specific facts. With that out of the way, let us proceed. Let us clarify UTMA Basics. A UTMA is a custodial account where assets are held for the benefit of a minor, with a custodian managing those assets until the child reaches the age of majority. Gifts made to a UTMA are irrevocable and become the child's property. Importantly, the tax basis of gifted securities generally carries over from the donor to the UTMA. When the child's account sells appreciated assets, that sale may realize capital gains for the child. However, those gains, along with dividends and interest, are considered unearned income. Unearned income does not count as earned income for Roth IRA eligibility. Furthermore, depending on thresholds in a given year, unearned income may be subject to the Kiddie Tax, potentially taxing part of it at the parent's higher marginal rate. With these foundations in place, we can now examine why capital gains cannot open the Roth IRA door. This flowchart shows the branching logic that determines Roth IRA eligibility. It starts with the question of income type. On one branch, we have earned income, such as wages reported on a W-2 or self-employment income reported on a 1099. That branch leads to eligibility for Roth IRA contributions, limited by the annual IRS contribution cap or the child's earned income, whichever is lower. On the other branch, we have unearned income, which includes capital gains, dividends, and interest. That path leads to ineligibility for Roth IRA contributions. There is also a warning that unearned income in a UTMA can trigger Kiddie Tax liability above annual thresholds, potentially at the parent's marginal tax rate. Turning to eligibility. A Roth IRA contribution for a minor requires earned income. Examples include wages reported on a W-2 or self-employment income reported on a 1099. Investment income does not qualify. The contribution amount is limited to the lesser of the annual IRS contribution cap for the year, or the child's total earned income for that year. It is acceptable for a parent or grandparent to provide the cash that is deposited into the Roth IRA, but only if the child has actual earned income sufficient to justify the contribution. It is essential to keep thorough records such as pay stubs, invoices, timesheets, and bank deposit evidence to substantiate the income. Here we compare earned and unearned income. Earned income includes W-2 wages from a legitimate job, self-employment income reported on a 1099 when real services are provided to real customers, and reasonable compensation for bona fide work in a family business. It must be supported by documentation such as hours worked, duties, and payments. Unearned income, by contrast, includes capital gains from selling stock, dividends, and interest from investments, UTMA asset sales, and gifts or allowances without work. Only earned income counts toward Roth IRA eligibility. This table provides a high-level view of the Kiddie Tax structure without quoting specific dollar thresholds that change over time. Up to an annual threshold, the child's unearned income may be taxed at a low or child-specific rate. However, amounts above that threshold can be taxed at the parent's marginal rate. This design can undermine the intended tax benefits of moving investments to a UTMA if substantial unearned income is realized. Now, Let us focus on the legal path to fund a minor's Roth IRA. First, the child must do legitimate work, either through W-2 employment or by providing real services and receiving 1099 self-employment income. If the work occurs in a family business, duties must be bona fide, compensation must be reasonable for the age and tasks, and all payments must be properly documented. Next, track hours, tasks, and pay rates. Keep every document you can: W-2s, 1099s, invoices, timesheets, and bank deposit records. Then, open a custodial Roth IRA with a brokerage and contribute the lesser of the child's earned income or the annual contribution limit. Parents may gift the money used for the contribution, provided the child has sufficient earned income to justify it. Finally, comply with all tax filing, payroll, and self-employment obligations as applicable, and retain supporting records to withstand an audit. To be audit-ready, create a paper trail, prepare a written job description, maintain timesheets or gig logs, and document that the compensation reflects market rates. Keep W-2s, 1099s, invoices, and receipts. Retain bank statements showing the flow of payments and any transfers to the Roth IRA. Maintain brokerage statements for the custodial Roth account. Finally, include a short note reconciling the earned income amount with the contribution amount for that tax year. Quiz time. A minor sells appreciated stock inside a UTMA and realizes a $3,000 gain. Does this gain allow a Roth IRA contribution? Option A, yes, because any taxable income qualifies. Option B, yes, but only up to $2,000. Option C, no, because it is unearned income. Option D, only if the parent co-signs the account. You may pause the video now to think about the answer. We will discuss the answer in the next section. The correct answer is C. Capital gains are unearned income and therefore do not qualify a minor for Roth IRA contributions. The size of the gain does not change its classification. The key requirement is earned income, such as W-2 wages or 1099 self-employment income. Second quiz. Which of the following counts as earned income for Roth IRA eligibility? Option A, dividends from a mutual fund. Option B, W-2 wages from a summer job. Option C, capital gains from selling ETF shares. Option D, interest from a savings account. You may pause the video now to think about the answer. We will discuss the answer in the next section. The correct answer is W-2 wages from a summer job. W-2 wages constitute earned income. In contrast, dividends, capital gains, and interest are all unearned income and do not qualify for Roth IRA contribution eligibility. Here are the key points. First, capital gains, interests, and dividends are unearned income and cannot justify a Roth IRA contribution. Second, Roth IRAs require earned income, such as W-2 wages or 1099 self-employment earnings. Third, UTMA sales can trigger the Kiddie Tax, potentially taxing part of the unearned income at the parent's marginal rate. Fourth, while a parent can give cash for the Roth contribution, the child still must have sufficient earned income to be eligible. Fifth, thorough documentation is essential to withstand scrutiny. To summarize, a UTMA can be an excellent vehicle for investing on behalf of a child, but realized gains in the account do not create Roth IRA eligibility because they are unearned income. Roth IRA contributions require earned income only. Be mindful of the Kiddie Tax when realizing significant gains within a UTMA. Focus on legitimate work, reasonable compensation, and strong documentation to fund a minor's Roth IRA properly. When questions arise, consult a qualified tax professional. Thank you for watching. If you found this helpful, please like the video, share it with someone who needs it, and subscribe for more content. In the comments, tell us how you plan to build earned income for your child and what questions you still have. Your feedback helps us create better guides.